All right, today we have a stock analysis of Oracle. So we're going to get into this large database provider to a lot of large enterprises and talk about why they're popular in the news based on their recent earnings report. And then we're going to go into the fundamentals and end with evaluation to see if we believe this is a good time to invest in Oracle. So why is Oracle so popular in the news? So let's start in January, where the Stargate project was announced. Now, the Stargate project is a new company which intends to invest $500 billion over the next 4 years building new AI infrastructure for OpenAI in the United States. So pretty much it was an announcement made by Trump, and what is going to happen is OpenAI and a lot of other large companies are going to come together, joint investment, be operational partners, and build new AI infrastructure so that the US can be a leader in the AI space. Now, let's talk about some of these partners. We have ARM, Microsoft, NVIDIA, Oracle, and OpenAI. So we see out of all of these companies, when it comes to providing infrastructure for the databases, Oracle is in a good position when it comes to this company and its investment and also moving forward. Here's the thing. September 9th, they came out with their earnings. And here's the big deal of why this stock popped so much. Q1 says remaining performance obligations, so their backlog, their contracts that they have signed and that they expect to earn revenue from, went to $455 billion. Now, for reference, this is a $57 billion company this past year as far as the revenues. So they're saying we have about 7, almost 8 years of our current revenues loaded up in our backlog right now. 359% increase. So that is a major increase in their backlog. So pretty much companies are building their AI infrastructure, and Oracle is in a position to provide that. Since they already have partnerships with so many large firms, this is a big deal for them. So here it says the multi-cloud database revenue from Amazon, Google, and Microsoft grew at the incredible rate of 1,529% in Q1. So they have large agreements that are growing with Amazon, Google, and Microsoft. These are the 3 cloud computing hyperscalers. These are the people that are pretty much defining the cloud computing industry in the United States, and Oracle is in prime position to benefit from that. So this is why the stock reacted the way it did after the earnings. So looking at this 5-year chart, we see that this stock was hanging around $230. Then we get a pop to $308 after the earnings announcement, with a significant dip here at the beginning of 2025. But as we see, they turned that around and now they have this major pop here. So we have a significant increase, very sharp increase for most of 2025. That's where we are with the stock. Now let's look at a few of the stats of this company. Right now they are at $177 billion market cap, PE ratio of 71, pretty high right now, but we'll look at the fundamentals to see if this PE ratio makes sense as far as an entry point. Earnings per share, $4.32, forward dividend to $2, that's about 0.65%. And we'll do a dividend analysis as well as we get into these numbers. So starting off with the segments, we want to know, how does the company make its money? So we have 9% from the services business, 5% from the hardware, but we see cloud and licensing business, 86% of their revenues. And this the largest part of their business is the business that is poised to continue to explode over the next few years for those performance obligations. So let's look into the revenue trends to see where they are. Now, this is an interesting position this business is in, because we're looking at a very established business that is experiencing, looks like there's going to be some exponential growth over the next few years. But if we look at the trends over the past 10 years aren't the most impressive. We got a 4.3 average growth rate of revenues over 10 years, 8.1 for the last 5 years. So we see we have 3 years, where the revenue declined over the past 10 years. It's not the typical sign of a company that has at a great entry point where there's a catalyst for a lot of explosion in their revenues, but that's where they are, even though they've had this trend. Over the past few years, we got 3, 4, 17, 23 was a good year, 6 and 8. So mostly modest years, averaging less than 5% over the past 10 years, 8%. So I would say right now, modest growth trend. Not the most impressive, but again, when it comes to stable companies, this is what you can expect. Mature businesses, but they're looking to be experiencing a mature growth stage. It looks like it's going to be a high growth stage as well over the next few years. Let's look at their gross margins. Software businesses typically have strong margins, so we do expect to see something like this. We have 77% over the past 10 years, 74 over the past 5. So we see they pretty much stay around that 70 to 80% range as far as their gross margins. Has a pretty significant dip over the past few years, 79 then down to 70. But for the most part, they're in that 10% window. Looking at their net profit. So gross margins is what's left over after you deliver the product or service, after you take care of all of your other expenses, your sales and marketing and accounting and research and development. This is what's left over, your net income. So we have 8.9 going up to 13, down a little bit to 12.4, but we see 22%, 22 and 21% when we're looking at the 10-year and 5-year average respectively. So pretty consistent in that range, ending at 21% since 2025. Their fiscal year, I believe, is, if I'm not mistaken, is March 2025. But so the 25 fiscal year has already wrapped up. That's what we're looking at now. So let's look at the free cash flow. So we do see this negative, but we're going to get to that in just a moment. So for the most part, they've had some, again, 5 years where cash flows have decreased. Again, we're talking about a mature business, pretty established, not a whole lot of growth. So they're not going to see cash flows growing every year, depending on what that company has to do as far as reinvestment into the business. But we see they were at 11.8 in 24, but we see a negative 394. Why does cash flow drop down so low this year? Why are they at the negative? So let's take a quick look at their balance sheet because I want to point out something. So they have to prepare to earn those revenues that we talked about. If they're going to bring in $455 billion from database and AI infrastructure, they're going to have to invest to build that infrastructure so that they can earn those revenues. So when we're looking at the free cash flow, we're looking at two numbers. The cash generated from operations, from running their business, they generated $20.8 billion of cash that came in the door. Then they spent $21.2 billion on investments in property and equipment. So they're building out the infrastructure and the databases that they need to serve their customers. Just for reference, over the past few years, we got 2.1 billion, 4.5, 8.6, 6.8. Then we have this jump to 21.2. So we do have negative cash flow for the year. We spent more on investment in the property, plant, and equipment than we brought in from operations. However, this should be expected. They are expected to spend about 88 to 90 billion over the next 4 years to build this infrastructure. So we can expect negative free cash flow for the next few years. It's not a bad thing because they are reinvesting into the business to earn money that they already have signed contracts for. It's not necessarily a guarantee. These contracts can change. They could be pushed out. They could be canceled. Things can happen, but management is saying, hey, we got to earn this money. We already have these agreements. Now let's pull the trigger on this investment and put money into the business to earn it. So to get this 455 billion increase in revenue, they estimate that they need to build about 88 to 90 billion dollars to earn that. So we're looking at about 20% of that money coming in going to building infrastructure, which will continue to help them build more and earn more revenues beyond that 455 billion as they get new contracts. So that's why we're looking at negative free cash flow in this year. As far as our analysis, we understand this is an anomaly. This is not the normalized environment. We saw what they were doing with their cash flow and investments before. Now they have a negative year. So that makes sense for the position that they're in. So we're not going to allow that to alarm us. So now let's look at debt. Now, anything over 5 years free cash flow, what I do is I look at the debt and I compare the debt to their free cash flow. Since the free cash flow is a pot of money that in which they would pay their debts off, how fast can a company pay off their debts with their free cash flow? 3 years or less, we love. 5 years or less, we like. But anything over 5, we typically see that as a heavy leverage company. So definitely that. Over the past 3 years, they're averaging 13.4 years to pay off their debt with their free cash flow. 10.7 years over the past 5 years. So free cash flow to debt, the trend is getting worse. Does that make sense? We don't like it, but given the position where they are, they have to get money to pay off these debts, or excuse me, they have to get money to pay off this infrastructure. They have to reinvest in the business. So this company, I can see them acquiring more debt to invest into the company with that 88 billion that's going to be estimated. So with that said, I don't like that. I really don't like these years. These are okay, not as bad, but this is where I don't like them to be, but it makes sense for them to do it as they are investing into the business and pretty much kind of redefining what it is they do for their customers. So again, a little bit worse than the free cash flow position, not like, but this isn't horrible given the situation. Assuming that they are going to earn that 455 billion, this is what you would expect. You're going to expect share count to go up because they're going to bring in some capital to reinvest into the business and get some debt to reinvest in the business. So the financials aren't going to be the prettiest from those perspectives over the next few years, but the company should be putting money back into itself to get a high return. So that's what we're thinking about. Looking at the dividend. So dividend yield over the past 12 months, we're looking at 0.58%. That is not the most important number to me. I like to look at the payout ratio. How much of that free cash flow is being paid out in a dividend? So 37% of their free cash flow is being paid to their investors as a dividend. That's where we are. Now, when we think about growth, let's look at their past 2 years. Pretty solid growth. 25% growth this year, 25 last year. We got 33%, 26%, 26. So solid, well above the average dividend growth that investors have experienced. But when we're thinking about the future, they have to invest around $88 billion into their infrastructure. So I would not expect this dividend to continue to grow at this double-digit rate. If it is, I would say probably barely 10%. But as a shareholder, I don't expect to continue to earn that 25% growth rate. I wouldn't even be mad at 6% or 7% or even 5%, given the fact that they are reinvesting into the business to improve the enterprise. So solid, pretty safe dividend, I would say, with this free payout ratio. However, with so much of that cash flow going to the infrastructure, don't expect growth from this. Let me rephrase that. Don't expect high growth from this dividend moving forward. So let's get into the shares. Share count is pretty interesting. We love to see a downtrend. We like to see companies take extra capital, purchase shares, take them off the table, leaving more of the company to the existing shareholders. So this is one way that a business can add a lot of value to the shareholder. That's not a reinvestment into the business and it's not a dividend. So we always want to know, what are they doing with the share count? So we see Oracle had been paying down shares up until 2024. We see a slight increase here and a slight increase there. Again, this shouldn't bother you. One, it's not a high increase in the share count. The trend is still down because they're down from 2020. However, what's going to happen in the future? Is the share count going to continue to creep up? I would expect it to creep up for the next few years as they probably want to bring in cash that is not debt, that doesn't have an interest, that they don't have to pay back to reinvest in the business. So as long as a company is growing and improving the enterprise at a much faster rate than they are purchasing shares, you should be safe for the most part. Being that this is a mature company, once this thing gets rolling and that investment is done, I believe that they'll continue to purchase shares and bring that share count down in the future. So I think their share policy right now is appropriate for where they are. So now we're going to look at the economic value added. So does the company generate value through its operations? We want to look at the capital that they put into the company. What's the return on that capital? And compare it to the cost of that capital. What is the interest rate on the debt? And what is the opportunity cost on the equity, the cash that you have sitting on in your business that you could invest in the market and earn 10%? There's an opportunity cost associated with that. So we look at the blended average of that to see this company has a 14.5% return on capital, and the cost of that capital is 3.1%, around 3.2. Value created over the past 5 years are averaging increasing the economic value of this enterprise by 11.3%. So that's a solid spread. And we like to see a company, if you're going to be opening and running your business, you want to be growing and having more economic viability as the years goes on. And Oracle is definitely doing this. So looking at the valuation of the business. So Oracle is projected, I'm projecting them to grow at a compound growth rate of about 45%. Many analysts have them growing at a higher rate, at a much higher rate, but I like to be somewhat conservative. I don't like to have huge margins of safety, but I do want to be conservative in my estimate. So 45% is what I am estimating. When it comes to my discount rate, I'm going to use the higher of the 5-year treasury or the weighted average cost of capital. So we're going to settle at that 3.7. Average free cash flow. So what I do with my terminal value, if I were to sell the stock in 5 years, how many times the free cash flow amount could I expect from this business? Oracle's been trading at an average about 18%, minus the last couple of years since they've had more increased investment into the business, around 18 times free cash flow, not 18%, excuse me. 18 times free cash flow. Cash flow for 2024 was at 11.8. I believe that after they get done with this reinvestment, they'll get back to this average and continue to grow their cash flows at a higher rate than they've done before. So with the stock right now trading at $308, I'm estimating the fair value to be about $320. Looking at a small potential upside of 3.7%. So that 308 is pretty much in the middle of that 288 to 352 fair value range. So my estimate is that Oracle is fairly priced right now. So not undervalued, not a deep discount right now, especially after that significant increase over the past few months, and not undervalued, not overvalued. So you're not overpaying for the stock right now. You're getting a solid, safe dividend that's going to be there, not going to grow a whole lot, but you're getting an enterprise that's getting ready to explode in value as well over the next few years if the backlog pans out. So I will say you have to have a good memory. Your best asset as an investor is your memory. You have to remember when announcements are made. Remember that. It feels good. You get excited. But also remember all the times that the announcements are canceled. Remember Apple. They said they were going to come out with a smart car and with a partnership with Hyundai. Didn't happen. They scrapped it. So a lot of announcements that are made and are heavy in the news cycle often get canceled and don't pan out. So you don't want to be left holding the bag just because you're investing on the news. So make sure you're comfortable with not just Oracle, but you want to make sure they're comfortable with all of their customers. Of course, they have some big ones, Amazon, Google, and Microsoft. So of course you have a lot of revenue there. No way to not be uncomfortable, no way to not be comfortable with those customers. But as far as the continued growth in the AI infrastructure, make sure you're comfortable that 455 billion, and make sure you have the high confidence that that's going to pan out before you invest in this company. If so, then I think this is a solid investment. So that's my analysis of Oracle. Let me know what you think in the comments, and I hope to see you in the next video.